So this is a continuation of a problem that we started in class. So this is chapter 1. Now, if you'll remember, in class, we were working on this problem, and we've got Bill and Mercedes, and they have $160,000 of taxable income, an additional $10,000 of non-taxable income. And remember that we talked about this non-taxable income, and we explained that that could be from a variety of sources. So I recommend you go back and look at, there's a video for the full chapter 1 Canvas PowerPoint presentation. And so I recommend you go back and take a look at that and get the context of this whole discussion, okay? So in class, we figured out what their tax due was, and I'm just going to write down what their tax due was, so we have that handy. So remember that we used the tax rate charts and found that based on this $160,000 of taxable income, they had $25,028 of tax due, okay? And so remember that when we figure out our average tax rate, that is tax liability divided by taxable income. And so what that gives us is this 25,028 over our taxable income, which was 160,000. And so that gives us an average tax rate of 15.64%. Remember also, I'm going to move things around just a little bit, that our effective tax rate is calculated using that same tax liability, but this time it's over total income, all right? So that'd be over 170,000 because total income includes both our taxable income and our non-taxable income, okay? And so what we get there is a slightly lower 14.72%. And remember, in class, we talked about the fact that it makes sense that our effective tax rate is less than our average tax rate if we have this non-taxable income. Anytime your denominator is larger, then that percentage is going to get smaller, okay? So that's kind of a short recap of what we talked about in class last Wednesday. Now, the last part of this problem asks us a different question. The last part of this problem asks us if they receive an additional $80,000 of taxable income, what is their marginal tax rate on this income? Okay, so that is a slightly different question. So in order to answer that question, we have to do a couple of things. So first, all right, we know that they started out with $160,000 of taxable income, all right? But then they get this $80,000 of additional taxable income. So what does that do? That gives them $240,000 of taxable income now, all right? So previously, So previously, they had $160,000 of taxable income. Now, they have $240,000 of taxable income. So this is their old taxable income, and this is their new taxable income. Okay, so I'm going to move forward on a slide so that we can look at our tax rate schedule. All right, and so we had our average tax rate of 15.64%. We had our effective tax rate of 14.72%. And so now our marginal tax rate on this new increment of income is 22.83%, right? Does that all make sense? Well, I say yes, it does, because remember, their marginal tax rate on this $160,000 of taxable income that they had originally, that marginal tax rate was 22%. If we look at our tax rate schedule, right? They started out in that 22% bracket, and then they end up in the 24% bracket. But all of that income, all of that $80,000 of income that gets added to that $160,000 doesn't end up in the 24% bracket. So their marginal tax rate on that increment of income is going to be slightly less than the tax bracket that they're dropped into. All right. Remember, in general, their effective tax rate should be the lowest as long as they have taxable income and non-taxable income, right? Then their average tax rate should be a little bit higher than their effective tax rate, again, assuming that they have both taxable income and non-taxable income. Okay, and then their marginal tax rates are going to be higher than that. All right, so that is the completion of the problem that we started in class. There will be another practice problem video posted for chapter 1, and then there is the PowerPoint discussion video posted for chapter 1 as well. All right, so this is our tax rate schedule. I'm going to make this just a little bit bigger, okay? And now remember that Bill and Mercedes are married filing jointly, okay? And so when we're married filing jointly, we're interested in this quadrant of our tax rate schedule, okay? So remember, in order to find tax liability, we drop our taxable income into this tax rate schedule, okay? And remember that when they had 160, I'm going to change my color here so we can see it. When they had $160,000 of taxable income, they were in this 22% bracket. Now that they have $240,000 of taxable income, they've moved to a 24% bracket. But look at these brackets, right? So not all of that $80,000 of extra income is in this 22% bracket, and not all of it is in that 24% bracket. So in order to figure out what the marginal tax rate is on that $80,000 of increment, we have to look at the old versus the new, okay? So let's do that now. So all right, so in order to find the marginal tax rate on this new increment of income, we have to look at our new tax liability minus our old tax liability divided by our change in income. Okay, so that is going to be our marginal tax rate on that increment. So what do we already know? Well, we already know our old tax liability, right? Our old tax liability, we just get to use from the previous parts of this problem. So our old tax liability is $25,028. Our change in income was given to us. That's $80,000. So now what we need to find out is our new tax liability. And so in order to find out our new tax liability, we have to go back to those tax rate schedules and use our tax rate schedules. So let's figure out our new tax liability. I'm going to slide this down. So our new tax liability is our tax liability for $240,000 of taxable income, all right? And remember, we need to use the married filing jointly tax rate bracket, right? And so in order to find our tax liability, we start out with the $35,302 related to the tax owed from those lower tax brackets, right? Because we're dropping into the 24% bracket, plus, plus 24% of 240,000 minus $206,700. Okay. So it's 35,302 plus 24% of that's 35,302 plus 7,992, which equals $43,294. Okay, so that is our new tax liability. Okay, so if we scroll back up here, our new tax liability is this $43,294. Okay, so all we have to do then is subtract our old tax liability from our new tax liability and divide by 80,000. All right, so I'm going to scroll back down and let's do that. and we get 22.83%. And remember that 22.83% is the marginal tax rate on the new increment of $80,000 of additional taxable income. Okay? And if we look back, so I'm going to go back now.